Good afternoon, everyone. Myself, CA Raj Chawla. Welcome you all in this today webinar on GCC. And today we have with us CA Parag sir. He will take up today webinar and our moderator, CA Mr. Sinha. He will moderate and will give you the brief about our today speaker as well as what points he will cover. So over to Mr. Sinha.
Welcome everyone in the webinar. I am really excited to host this webinar from the lands of Goa. And now, am I audible?
Yes. Audible.
Okay. Very recently we had a 2 days seminar in Delhi on GCC and overwhelming response we had in that seminar. After that, C. Raj Chawla sir has organized this webinar on the GCCs, on the importance of GCCs. So please welcome today's speaker, CA Parag Garg sir. CA Parag Garg is a chartered accountant with over 15 years of specialized experience in the international taxation and transfer pricing with Big Four consulting firms. He has dedicated 9 years of advising in domestic and international firms in India, and since last 6 years, he is based in the Middle East in UAE, Saudi, and Qatar. He brings deep expertise in current taxation, international taxation, and transfer pricing. Among all the things, one thing is very important to brief here, that for GCCs, Parag sir has cross-cultural fluency in SAR by experience working in over 5 countries and collaborating with professionals from more than 15 countries, including US, Canada, UK, Europe, Africa, Gulf countries, China, and others. Apart from ICI member, CA Parag Garg has a first-class graduate degree in commerce and economics from University of Delhi. So please welcome again CA Parag Garg sir for the topics to be covered today in this seminar. We are going to cover the topics mainly on international taxation, the role of GCCs. So please welcome CA Parag Garg sir. Sir, please.
Thank you very much, Raj sir, and thank you very much, Sinha sir, for such a nice and lovely introduction. I know you are outside somewhere. Probably we may have some network issues, but really grateful to be here. Thank you very much. And thanks to Raj Chawla sir also for, and your team, of course, Keshav, Divya, for making it possible, giving me this opportunity, this platform to interact with fellow colleagues, fellow professionals. My name, as Sinha sir mentioned and Raj sir mentioned, my name is Parag Garg, and I am a chartered accountant. Have most post qualification approximately 15 years plus experience. All of it is in Big Four. I have been doing transfer pricing and international taxation in India, and of course in the Middle East. Since last 6 years, I have been based in Middle East. Let me just begin my presentation. So please give me just a minute. And can you please tell me if my screen is visible to everyone?
Yes, sir, you are visible.
Okay, perfect. And probably we can start the presentation, or we have all the people joining in. Probably people are still joining in. However, I will start my presentation. What are we going to cover in the next 1.5 hours? And before I do that, a few disclaimers and some requests to our audience. Welcome to our audience, first and foremost. What a lovely audience we have today. People are still joining in, so maybe we can give them a little bit more time, couple of more minutes. A few disclaimers. Whatever information you will see in this presentation today, it is based on my own research over the last 1 month and some industry reports, etc. And whatever views I will express today in this session are all my personal views and not necessarily views of my organization or of ICAI. So I need to be clear on that. And second, a request to all our audience. If you have, I really like this session to be as interactive as possible. So if you have any questions, you can raise your hands. I will take intermittent pauses, breaks, and I can take up some questions then, or towards end of this session, we will have a proper Q&A round. If you have any questions, you can just post your questions in the Q&A box or chat box, and I will ensure that we are covering all your questions within the session. So on that note, let's begin with our agenda. What are we going to cover in our session today? Is my screen visible and it's working? I'm on the agenda slide, content slide. I guess yes. Then if you can give me a thumbs up or just say yes. Perfect. Okay, perfect. Thank you very much. So as Sinha sir mentioned, I will probably take a step back and let everyone know how did I come up with this very interesting topic, very exciting topic. So as Sinha sir mentioned, last month towards end of June, on 28th and 29th of June, there was a 2-day summit held by ICAI in New Delhi, and I happened to attend that summit. It was a marvelous event for 2 days, all about global capability centers, or GCCs as we call them. It's a, the content or the information which was shared in those 2 days was more with respect to infra development, cyberspace, data security, reforms, the government reforms which are coming up in this industry. And within those 2 days, there was a one dedicated session on the taxation aspects around GCC industry, and that was a half an hour, probably 45-minute session. We had some great panelists in that session discussing about taxation aspects, but of course it was a mixed kind of session with various work streams or various taxation streams. So that's where I felt that we probably need little bit more deliberation on the transfer pricing aspects or international tax aspects in the GCC industry, especially given the size of GCC industry in India and given the scale or the share with GCC with which India holds in the global GCC space. So on that thought, I started doing some research. I read various reports published by NASSCOMs, and various other domestic and international publishers, and then came up with this presentation. So what are we going to cover in next 1.5 hours is, the way I have divided this presentation is into 4 sections. Section 1 is purely dedicated on GCC. What are the GCCs doing in India? What is the market share of GCC in the Indian GCC industry across the globe and in India? What is the market segmentation, segment market size, and how GCCs have evolved over a period of time over the last 1.5 to 2 decades. Then section 2, we will deliberate more on the transfer pricing technical aspects. What are the transfer pricing models or methods prevalent in this industry? What are the transfer pricing audit issues faced by taxpayers? What are the emerging transfer pricing audit issues in the Indian GCC space? And of course, what are the dispute resolution or dispute prevention mechanisms available to the taxpayers in India? Third section, we will discuss around the other tax aspects or other tax issues within this industry beyond transfer pricing. Of course, it will include some international taxation issues. We will just touch upon those points. And in the end, I will summarize what are the opportunities, challenges faced by by this industry or by the professionals, and what are the key takeaways from the session. In between, as I said, I would really like this session to be as interactive as possible. So in case you have any questions, don't hesitate to drop a note in the chat box immediately, or you can raise your hand and I will come back to you on that note or that question. So without further ado, let us look at the evolving GCC landscape, global and Indian context. So first section is dedicated on the GCCs as an industry. What are GCCs? What is the market size, global market size? What is the Indian market size, and so on and so forth. What are GCCs? I'll take it from the very basics, and then I will gradually build on the technical aspects. Global Capability Centers, or GCCs as we call them. We also know them as Global In-House Centers, or GICs. These are the offshore hubs set up by big multinational companies, big multinational brands, who are setting up the offshore centers in, of course, not in the main jurisdiction, in some offshore jurisdiction, to centralize some of their functions or activities. Those functions or activities could be core functions related to their business, which are revenue generating activities for the multinational group. Like you have engineering design centers, research centers, and so on. Or those could be non-core activities or non-core functions for the multinational group. For non-core, in the sense, those are not revenue generating, those are support functions as we understand them. And these includes finance, HR, admin, IT support, and so on and so forth. India, by end of 2024, and by the way, this is based on the report published by NASSCOM along with Zenov, hosts, by end of 2024, hosts more than 1,700 GCCs and employs approximately more than 1.9 million professionals in this industry. And when I say 1.9 million professionals, I'm not necessarily talking about accountants or finance professionals. It includes other professionals from other domains also, i.e. engineers, medical professionals, lawyers, MBAs, and so on and so forth. So a lot of people are already involved into this industry. How the GCCs have evolved over a period of time, although we will have a dedicated detailed slide in the subsequent section. Initially, they started off as cost arbitrage centers. Later on, they transformed into innovation hubs, and gradually, and what we have seen recently, they have now started creating strategic value for the multinational group, for the overseas multinational group. That's how GCCs are evolving over a period of time. Let's look at the global market size of GCC industry. If you look at the reports, and this information is coming from my research and from the industry reports, the global GCC industry was valued at $95 billion, US billion dollars, in 2019, which by end of 2024 stands at $120 billion. And the growth rate, if you see, it grew over the last 5 years. It grew at a compounded annual growth rate of 5% YOY. And if you look at the next 5 to 6 years, the global industry is all set to grow at a compounded annual growth rate of more than 10%, and probably will become more than $160 billion industry. So look at the magnitude of growth in this industry. Last 5 years, global industry grew at a rate of 5%, and next 5 years, double the growth rate. If we look at the market segmentation, the market in GCC space is dominated by IT and software companies with a 40% market share, followed by engineering and design centers catering to 25% market. And then it is followed by other streams, analytics, AI, and other support services functions. However, I will not be surprised to see this analytics and AI, as we have seen in the last 1 year or so. All the new technologies, OpenAI, Deep Tag, DeepSeek, and so on and so forth. I will not be surprised in the next 5 to 6 years, you will have a major share of analytics and AI in this global pie. Now, where does India stand in the global GCC industry landscape? So if you look at the heat map, which I have produced here, India, as you can see, is shining really bright in the world with a dark blue color. India caters basically 53% of the global market. The global GCC industry is within India. It means undoubtedly India is an undisputed leader in the GCC industry for the world. We are the global delivery center for the world, and really proud to say that. Is there any global competition for India? Yes, of course, there are. You can see some of these countries which are into sky blue color or light blue color. There you will have some competition. The closest competitor of India in GCC space is, of course, Philippines with approximately 10-11% share. And then you've got in Americas, if you look at, you have got America, Brazil, Mexico. In Europe, you've got Poland, which is upcoming as a GCC hub or an outsourcing hub for at least for European companies. In Africa, you've got South Africa. In Southeast Asia, if you see, you have got China, you have got Indonesia, Malaysia, and Philippines, and Vietnam as well. As these countries also have offshore hubs in their locations. So of course, competition is there. Still, India holds the first position in the entire global GCC industry and will continue to hold the lead position in this industry, hopefully. What is the Indian market size? Again, all this information is coming from a NASSCOM published report. If you look at the chart on the top left corner, Indian GCC markets grew from 40 billion US dollars in 2019 to 64 billion US dollars by the end of 2024. And if you look at the growth rate of Indian industry, it is close to 10% versus the global GCC industry, which grew at a 5% growth rate year on year in the last 5 years. India grew at double the rate, at 10% growth rate. In the next 5 to 6 years, it might become $100 billion industry only in India. I'm talking about with a growth rate of annual growth rate of close to 10%. Now, a question and a deliberation for everyone. If I connect the growth story of India versus the world, in the last 5 years, the global industry grew at the rate of 5%, whereas the Indian industry grew at the rate of 10%. And in the next 5 years, 5 to 6 years, global industry as well as Indian GCC industry are poised to grow at in double digit, in 10% growth rate. Is it possible for India to outpace the global growth and achieve a faster growth, faster than probably 10%, maybe 12%, 15%, or even higher? I would say, if you ask me, my take is, of course, it is possible, very much possible for Indians and India to outpace the global growth rate and grow at a faster rate. Now, the real question is, what would it take for us as a citizen of India to make sure we are growing at a faster rate and delivering the top quality services to the world? Well, there are 3 pillars to it. Pillar 1 is policy reforms, which are required from the government side. Policy reforms in the form of infra development, infra reforms, social security reforms, real estate reforms, or even the tax reforms that are underway. Recently, we have seen opening of Gift City in Ahmedabad in Gujarat. And that is one kind of reform. Probably that is the need of the hour, is to have similar kind of reforms on pan India basis. So that's one policy reforms required from the government side. Second is the role of institutions which they need to play to make sure the students who are coming out from those institutions are actually future ready. When I say institutions, I'm talking about not only ICAI, I'm talking about other institutions also, like IITs, IIMs, medical institutions, and so on and so forth. So all of these institutions also have to ensure the curriculum which they have or they might have in the future is including the latest trends, latest technological development which are happening across the globe, or the latest, let's say, developments in the law, any new regulations, and so on and so forth. Third, and the most important pillar of this growth story is, of course, the individuals, us. We also have to be really, really competitive. And when I say us, does not necessarily mean only accountants or only finance professionals. I mean engineers from India, medical professionals, lawyers, MBAs, whatever it is. We also have to be future ready, in the sense we also have a responsibility to learn and adapt new skill set, to make sure we are providing top-notch services to the world, because there is definitely a real competition outside India. We have, as we have seen in the previous slide, there are lots of countries who are now coming up as a offshore hub. So coming back to the presentation and the charts, if you look at the number of GCCs that have grown over a period of last 5 years, and for the next 5 years too, number of GCCs were approximately 1400 GCCs by end of 2019, which by end of 2024 stands at 1700 plus GCCs in India. And this number probably will cross 2000 mark in the next 5 to 6 years. If you look at the head count on the left bottom chart, number of people who were employed, or the professionals who were employed in the GCC setup, were approximately 1.4 million people in 2019, which now stands at 1.9 million people in 2024. And this number will probably go beyond 2.5 million by end of 2030. This is the expectation, market's expectation. Let's look at the market dynamics. Where these GCCs are based in India, of course, this is not a surprise to anyone. If you look at all the white circles on this India map, these are the major metro cities hosting most of the GCCs. And of course, Bengaluru, as you would imagine, is an outlier. Bengaluru in Karnataka has the highest number of GCCs, approximately 34% GCCs are in Bangalore, followed by Delhi NCR, Mumbai, Hyderabad, and Chennai. And this is not the point. The white circles are not the important points here. The point which I want everyone to focus on are the green circles that you see, the gray circle, sorry. The gray circle that you see here represents tier 2 cities. These are the upcoming destination for GCCs. For example, in north, you see Chandigarh. In the west side, you see Ahmedabad, Vadodara. In the east, you see Kolkata, and in south, you see Coimbatore, Thiruvananthapuram. So if I have to predict the India growth story in GCC domain, if we will be talking again after 5-6 years, I would put my bet on the gray circles, because you will probably see more gray circles on the India map rather than the white circles. And probably these gray circles which you see will convert into white circles. It means they will grow, and then you will see even the tier 3 cities will host GCCs in India. So that's the level of investment that's going into the GCC sector, and that's the magnitude of this industry, so to say. Which are the major players in this space. Major players in this space, these are all big multinational companies. Name needs no introduction. All big multinational companies. In finance sector, you have got HSBC, American Express. In consulting, you have got Deloitte. I'm coming from Deloitte, and Deloitte, by the way, has a very big center in Hyderabad. KPMG, McKinsey, all the big IT companies, Accenture, Dell, IBM, they have their centers in Bangalore. Internet companies, Google, Microsoft, they also have. Amazon has a very big center in Hyderabad, and so on. Let's shift our attention from the generic discussion until now to little bit more technical discussion on GCCs and see how GCCs have evolved over the last 1.5 to 2 decades. And let me tell you, this slide is extremely important, because this will lay the foundation of the rest of discussion we will have later in the later sections. So extremely important slides. I would really want audience to focus on this slide. What is the information being given or being shared on the slide? How GCCs evolved over the period of time, over the last 1.5 to 2 decades. I have divided into 4 phases, as I call them. Phase 1, where the GCC started working or operating as low cost center. It was known as cost arbitrage era, whereby GCCs were focused more on delivering compliance driven task or transactional task. For example, processing of accounts payable, accounts receivable, archiving information, and so on and so forth. They were getting instructions from the headquarters, and they were doing those tasks, the people sitting in GCC. And the GCC was considered as low cost back office service provider. Then came in process excellence era, where similar kind of operations, I would say. However, the GCCs became specialized in those operations, and they started process optimization and quality management. In the sense, earlier they were getting instructions only from the head office or the headquarters. Now, when they started specializing in those activities, other firms, other member companies of the multinational group from various jurisdictions started delegating similar activities to the GCC in India, and they became a specialized or a shared service center, so to say. So this was phase 2, still doing low end operations. However, they became expert in those operations. Then came phase 3, still going on, probably not that one era ends and then second era is starting. All this is going on, but this is how the functionally or activity wise GCCs have evolved over a period of time. Phase 3, where GCCs were focused more on doing analytics, development of processes, development of products, IP development, and they started creating more value towards the multinational group or the overseas group. They started doing a little bit of tech innovation, engineering design, and so on and so forth. Lately, we have seen at least some, if not all, the GCCs are focusing on becoming center of excellence. They have actually transformed their activities, and they are doing more value added functions, in the sense product development, prototype design, prototype testing, prototype digital labs kind of services. No more they are called a cost center. They have now transformed their activities, at least functionally, into the profit centers. They may have some global KPIs. The people sitting in GCCs may have some global KPIs. They are responsible for the development of a product or a process, which might lead to creation of some kind of intangible property for the group, which can be exploited at a future date or future time. So very important slide. And this is the end of first section of the session. I will immediately move on to the second section, which is linked to this slide. And remember, I will refer to this slide in the later section, later part of my presentation as well. Now let's look at, or let's discuss the technical transfer pricing aspects, navigating transfer pricing challenges in India in the GCC space, of course. What type of GCCs we see normally in India, and what are the functional profile? What is the functions, assets, and risk profile, which is more prevalent in the transfer pricing world? But before we get into this technical transfer pricing discussion, a quick question, if people can answer: are you well versed with the transfer pricing basics, or should I explain a little bit about transfer pricing? Although this is not our topic for today, but I just wanted to understand if our audience have some basic information about transfer pricing or not. There is a message. Let me see that. Please do. All right. Thank you very much, Dilbag. So transfer pricing, let me explain a little bit in probably 2 or 3 minutes, because we have only a limited time for the presentation. There are some other messages also. Let me read. No need. Mohib saying no need. Let me explain a little bit about transfer pricing. Transfer pricing is required to be done if there are two, let's say, entities dealing with each other. They are buying certain services, certain goods, or they are probably having some financial transactions, i.e. intercompany loan, or things like that, or maybe intangibles related transaction. And specifically, if you're dealing with a party in an overseas jurisdiction who is a related party as per the definition given in law. So if you're dealing with a related party in an overseas jurisdiction, in that case, you are required to have those transactions being conducted on an arm's length basis. This is a very widely accepted concept across the globe, very consistent application of transfer pricing rules across the globe. India also follows, in a way, OECD transfer pricing guidelines. Although India has developed its own transfer pricing law, rules, and so on and so forth, and there is a guidance note also issued by our Institute of Chartered Accountants of India. So in nutshell, if you are dealing with a related party overseas, however, domestic transactions are also under the purview of transfer pricing. So you will have to deal with them on an arm's length basis. It means you have to make sure you are following the prescribed transfer pricing method, and your prices are not overcharged or undercharged by anyone within the group. So very brief overview. If you want, we can have a separate discussion on the basics of transfer pricing or advanced concepts of transfer pricing. Coming back to the presentation here, types of GCCs and the functional profile of those GCCs. We have seen shared services center. I explained in the previous slide. Those are engaged in doing very low end functions, finance, IT, HR, etc. The asset profile is considered as low. Risk profile is also considered as low, and these activities are considered as non-core activities by the multinational group. Then we have customer service centers, those centers who are engaged in help desk and help desk support, feedback support, after sales support functions. Asset profile is considered as low. A risk profile is also considered as low, and these are considered as non-core activities again. Then we have knowledge centers, those GCCs who are entrusted only with documentation work, archiving the information, the documentation, making notes, making summaries. This is more prevalent in, I would say, the medical industry or the legal industry, where you would need people to summarize case laws, to make a summary of medical records, medical reports, and so on and so forth. Asset profile is considered between low to medium. Risk profile is also considered between low to medium, and activities are generally considered as non-core activities. Then comes engineering and design centers, where the GCCs or the people in GCC are engaged in doing engineering support services, design support services, mostly prevalent in, I would say, automotive, civil, analytics, IT industry, and so on and so forth. Asset profile is considered between medium to high, depending upon what kind of functions you are doing. Risk profile accordingly considered as medium to high, and these are generally considered as core activities of the multinational group. Then comes the latest in trend, or the last in the row, innovation centers, which are basically the research and development. Research could be a pharma, non-pharma, and those GCCs which are actually into prototype design, development, testing. They might have digital lab services and so on and so forth. Asset profile is considered as high. Risk profile is also considered as high, and the activities which they perform are generally considered as core activities of the multinational group. One quick point, you must be wondering, what do you mean? What do I mean by asset profile, low, medium, or high? So in transfer pricing reports or transfer pricing analysis, when we do a transfer pricing analysis of a company, when they are having a transaction with an overseas or other related party, generally we have to consider what are the functions performed by each of the parties and who owns, let's say, assets which have some kind of value, and who is assuming more risk in the setup, in the context of transaction that they are undertaking. So when it comes to the asset profile, you have tangible assets as well as intangible assets. Tangible assets are more important in, for example, manufacturing industry. You might say that for a manufacturing setup, you need to have tangible assets, i.e., the property, the plant, machinery, state of the art technology, state of the art machinery, and so on and so forth. So you might have some weightage of tangible assets also. However, in the service industry, for example, in GCCs, tangible assets may not derive that much value for the group, for their core business. What might drive value in this service setup is basically the intangible asset. And what is intangible asset? Of course, which is not tangible. Intangible asset is probably a formula, a design, a prototype, or something which the group wants to create, which may have a future revenue generating potential for the group. So if you are doing those kind of activities, and if you are able to, or if you can create those kind of intangible assets or properties for the group, then it is considered that the asset profile is medium or high. So that's why you see all the engineering centers or innovation centers are taxed with high asset profile. A little bit of background about the asset profile. Some question, no need. Oh, sorry. A GCC can be a combination of two types: support services, innovation centers, both or not. Yes, sir, definitely. Depending upon what kind of functions are being outsourced, it can have dual, or it can have multiple functions, multiple activities being outsourced, for sure, depending upon what kind of capabilities you have developed. Or gradually you may develop those capabilities. You start off with having a low what do I say, low cost or low value added services, and gradually you will have more and more difficult or weighted tasks assigned to the GCC. So you have developed that kind of capability, and you have built that trust also, because trust factor also plays a very, very big role in any kind of industry, including GCC, of course. Moving on. How can I move on? Okay, yes. Who has made some interesting modern art on the screen, digital art on the screen, but anyways, looking good. Transfer pricing methods or transfer pricing models, depending upon the functional profile of the GCC, as we saw in the previous slide. If you have non-core functions or non-core activities, it could be a cost plus method. If you have, or it could be a transactional net margin method, or TNMM as we call it in general terms, or in practice we call it TNMM. Cost plus method and transactional net margin method are not very different. Of course, the application is different, but if I have to give you an example, both are considered as a cost plus. However, a cost plus method, in a cost plus method, you will see what is the direct cost of providing those services by the GCC. That becomes your cost base, and then you apply a gross markup on that cost base. That becomes a transfer price. The transfer price which a GCC is expected to charge from its overseas headquarters or the related party, that is your transfer price under the cost plus method. Versus in TNMM method, the cost base will be different. The cost base would include direct cost, indirect cost, as well as the overheads of the business, and that becomes a cost base or a cost pool. Then again, you add a markup, and that markup will be a net markup. We call it net operating cost for providing the service, and then you add a net markup on that cost base, and that becomes your transfer price, which a GCC is expected to charge from the overseas related party when you are providing services from the service recipient. For non-core activities, these are the prevalent methods and remuneration model. For core activities also, by far, TNMM, the transactional net margin method, is the most prevalent method. The only difference could be you might add a little bit, the markup could be on a higher side than the core activities. You might add a little bit more markup for core activities than compared to the non-core activities. That's one. Second, and very important point, and you probably will not see this, the other method, the profit split method, too much used in any transfer pricing analysis, is the profit split method. This is generally used where the taxpayer is doing some kind of activities and probably creating some unique intangible asset along with the overseas related parties. And if that is the case, depends on the facts of specific case, of course. A lot of detailing, a lot of investigation, interviews are required to be conducted to understand what is the functional profile, what kind of value being created. Is it really producing a unique intangible or a unique contribution for the group or not? However, if it is proved that the local GCC company is adding a lot of value or probably creating some kind of unique intangible or a contribution for the overseas company, then a profit split method can also be applied. And how do you apply a profit split method? By the way, there are 5 methods prescribed by OECD. I have covered here only 3 methods. There are 2 more which are not covered here. And we are actually not discussing the type of methods, because if we have to, again, this is basics of transfer pricing. I can have one more session detailing about the basics and the transfer pricing methods. There are nuances on all of these methods. So how do you apply a profit split? It could be allocation of residual profit based on contribution by each of the company who is involved in providing or creating those intangibles. Very technical term. I am not expecting audience to to become a master in all of these terminology, but just for you to understand or to know, if you are dealing with a GCC setup, either you are employed there or you are working as a consultant or you are owning a GCC, so at least you should be aware of these transfer pricing terms because you'll have to face them. Moving on to the transfer pricing audit issues faced by taxpayers or GCCs in India. As I said, the remuneration model for GCCs is typically a cost plus model where you have a cost base and then you have an arm's length markup to be added. And there is a question. Let me see what is the question here. Can I just cover this slide and then come back to your question, please? Sorry, whosoever it is. My apologies. So there is a cost base and then there is a markup to be added. And tax authorities have challenged on both the components. They have challenged both the components, and there are numerous case laws on each of these aspects. So first, if I talk about the markup element which is to be added, and this mainly I'm talking about the TNMM method where you add a net markup after overheads and all. And a typical tax authority behavior, if you're charging 5%, they will probably be not happy with that and they will ask you to charge 10%. If you charge 10%, they will ask you to charge 15. And if you charge 15, they will ask you to charge more and more and more. Typical tax authority behavior, not just in India, overseas also. Currently, and these percentages which you see here on the slide are based on experience in Indian context. Tax authorities are seeking a net markup of anywhere between 18 to 22 or 24%, depending upon the type of functions or activities being done. And in very few cases, unreported though, in very few cases, they have not even hesitated to ask a 30% markup on your fully loaded cost. So imagine you're running a business and you are expected by the tax authority to earn a 30% net markup on your fully loaded cost. Like very, very profitable business, is it? So that's on the markup side. On the cost base that you see on the right hand side in the red box, these are 5 or 6 pointers I have mentioned, and the basic contention of the tax authority is they say that the cost base which taxpayer has produced in the transfer pricing report on which a markup is applied is not sufficient. Probably you'll have to add more costs which you are incurring or not incurring, and then you will have a cost base which will be acceptable to the tax authorities. Then you apply an arm's length markup, that becomes your transfer price. Now, what is the contention of cost side? For example, free of cost services. If the GCC is receiving certain services free of cost or certain goods free of cost, either from the head office or from a vendor who is a global vendor, who may be a global vendor, then the tax authorities ask you to impute a notional cost, add it into the cost base, apply a markup, and then charge it, or at least pay the taxes accordingly. Management fees or intra-group services fee, generally in a multinational setup, there are some regional services or some central services performed by the multinational groups from 1 or 2 locations. And those locations are basically cost centers, and those are cross-charged to the GCCs in India, operating in India. And typically those kind of charges are not routed back to the head office along with the markup. So the question is, you have to, or the contention of the tax authority is, you have to add it back to the cost base, apply a markup, and cross charge it. Subcontracting cost or pass-through cost. Sir, I'll take your question. Give me just 2 more minutes. I'll come back to your questions. Subcontracting cost is, for example, if the GCC is operating at full capacity and they have to deliver certain services, so they might delegate to a third-party service provider. In that case, if they are receiving an invoice from a subcontractor, they might not cross-charge it to, or they will cross-charge it to the headquarters without applying any markup. That is also, from tax authorities standpoint, they say, no, you have to apply a markup on, even on those pass-through or subcontracting cost. Foreign exchange gain or loss, very, very controversial or litigative aspect since beginning. If you have any foreign exchange gain or loss sitting in your profit and loss account, whether you treat them as operating, including the cost base, or you consider them as a non-operating and exclude from the cost base. Debatable depending upon facts of the case, and there are numerous case laws both in favor and against the taxpayer. So you will have to actually go and see, depending upon the facts of your case, whether you can apply a favorable ruling or you have to apply an unfavorable. You have to actually go and see the case of your facts and the case laws that we have. Share-based compensation, very normal, very routine transaction where the GCC personnel generally receive ESOPs from the headquarters, and for that there is a charge coming in from overseas company to the GCC, whether you include that in the cost base or not. Any accounting adjustments in the books of GCC, and if there are any additional costs or provisions because of those adjustments, whether you should include that into the cost base to apply a markup or not. So again, these are very factual aspects. You'll have to actually see what is the fact of your case. Numerous decisions both in favor and against those points you will find. You'll have to actually go and see that. Let me take your questions here. Sorry, what is this? So does this mean that GCC, hang on. Does this mean that GCC will be charging to the counterpart based on these methods? Yes, GCC, the most prevalent method is a cost plus TNMM method, and there are lots of case laws on this method. Generally, these are the issues which are faced by GCC taxpayers in India. There could be a profit split method also. There could be an hourly rate, or we call it cup method also. But if you're a captive service provider, then generally a cup method or the hourly rate method is not that prevalent. However, this is of course one of the methods, but this is the most prevalent method, the TNMM or the cost plus method. Is this slide of TP issues generally explaining the TP audit issues, or GCCs are actually facing? Sir, these are specific to GCCs. These are actually specific to GCCs, although these are general in nature, but all across GCCs you will find similar issues. Lots of cases. Okay, fine. Moving on. So once you have that, these are the historical TP audit issues, as I said, legacy issues which have been developed over the last 1 decade, 1.5 decades, and still going on, right? The next is, are there any emergent transfer pricing audit trends or audit issues? Yes, as I said in the slide, evolution of GCCs in phase 3 and phase 4, where GCCs are actually doing a lot of value added functions or probably strategic value addition. They are probably involved in creating some kind of intangible assets, intangible property, and so on and so forth. So if you have any of these fact pattern, depending upon when you do a proper functional analysis in a GCC's case, if you have any of these fact pattern, then probably you might have to get into a discussion or deliberation with the GCC as well as with the headquarters. How do you deal with those issues? If, for example, the Indian GCC personnel are having some overseas roles, if they are involved in any overseas roles, if they have global KPIs or global responsibilities, if the KPIs of the Indian head of the GCC is towards the development of a product which will be launched by the group, or if there are blurring allocation of functions between the headquarters and the GCC, they want to develop, let's say, certain new technology of a car, and that is being developed jointly with the head office and the GCC center in India. However, who is doing what? This is not very much clear from the documentation which they have on records and the agreements, the transfer pricing documentation, and so on. Blurring allocation of functions, or if the functions or the activities performed by GCC are actually very high value added functions, i.e., they are actually resulting in the development some kind of intangible property, patents, and so on and so forth, which at one point of time will be exploited by the overseas group in the market, and which will produce a future return for the group in future. Yeah, so in those cases, if you have any of these fact pattern, then either tax authorities would ask you to have a higher markup as high as 20-25% or even higher, or they might completely disregard the TP methodology which you have adopted and may try to apply a profit split method or some other measure to have more profit attributed to the GCC in India. Just you to be aware of, these are the emerging audit trends in GCC space. Now, if you have a transfer pricing audit, what are the transfer pricing dispute resolution route or mechanism that's available to the taxpayers in India? And I believe all the accountants sitting in this room, in this virtual room, by the way, have seen all this hierarchy of domestic dispute resolution route. I will take up your question. Just let me finish this slide first. Thank you. So it starts with the assessing officer or transfer pricing officer, and if they pass an order and you're not happy with that order, then you go to the next level, which is DRP, dispute resolution panel, which is available in a transfer pricing or an international tax case. Otherwise, you go to CIT appeals, Commissioner of Tax Appeals. And if you are not happy with the resolution which they have provided, then next is you go to IT-80 Income Tax Tribunal, which is also considered as the last fact-finding authority. And if you are unfortunate to get relief at tribunal level, and if your case involves a question of law or a substantial question of facts and law, then of course you have a High Court and Supreme Court door open. You have to actually follow, needless to say, you have to follow all the timelines prescribed in the relevant income tax section, all the procedural aspects, and so on and so forth. However, this is a normal transfer pricing dispute resolution route available to all the taxpayers. Now, in transfer pricing cases and in international tax cases also, you have an alternate dispute resolution mechanism that's available to the taxpayers, which is called mutual agreement procedure, or MAP as we call it in day-to-day language. You can invoke MAP proceedings if you have an assessment, and if you are not happy with that in a TP case, you can invoke a MAP proceeding. However, for MAP proceeding to be invoked, you need to have a double taxation avoidance agreement, and you need to have Article 25 available in the DTAA, which generally you will find in many DTAs. You will have Article 25. I have given the legislative reference here in case you want to go back and read more about this. This is an alternate dispute resolution mechanism. If you're not happy, you can invoke a MAP, but for you to invoke MAP, you have to reach out to the competent authority of India, and they will also reach out to the competent authority of overseas jurisdiction to settle transfer pricing and double taxation or international taxation disputes. There was a question here. Let me see. If the GCCs are performing value-added functions, won't they only be acting as the main company generating revenues and the back-end role is over? Yes. Kajul, you're talking tax authority's language here, unfortunately. So that's the contention of tax authority, that you are doing all the activities here, so you should be paying more taxes in India than overseas. Then what is the pricing of your intercompany transaction? That's the whole point of debate in this case. But life is not that simple. It's very complicated, you know. When you do a transfer pricing analysis, especially in these kind of cases, taxpayer or the consultants on behalf of taxpayer, they try to prove that what GCC is doing is not that value adding because there are other people sitting somewhere else who are playing much bigger role. And in some time, in some cases, this might be true also. Where is the head and brain of that particular activity or business is sitting? Is it sitting in India or is it sitting overseas? That is a whole point of debate. And there are arguments from both the sides, but it all depends ultimately how strong your documentation is at the first place, how strong your arguments are, and what factual information you can provide to support your claim. Factual information, when I say in transfer pricing sense, is actually the functions, the interviews conducted with the leaders of the business, operations of the business, not only with the finance department. You have to actually go and talk to, for example, the procurement department, the sales department, the manufacturing department, and see what are they exactly doing. And in GCC setup, you have to, for example, if an engineering design center you have, so you have to go and actually see who are the heads of those engineering setup and talk to them and understand in the whole value chain of the product across the company, what is the value being created in India by those GCC personnel versus what is the value being created outside India. So it all depends what kind of documentation you have and how best you can support your claim. I hope it's clear. We will talk in the end, don't worry. So these are the dispute resolution routes that those are available to the taxpayers in India. Let's look at what are the dispute prevention mechanism available to the taxpayers in India. And as you all know, prevention is always better than cure. So some mechanism or tools available to the taxpayers in India to prevent any dispute to happen. At least we call it like that as a expert in this domain. One quick question from my side. Should I explain the APA? APA, by the way, stands for Advanced Pricing Agreement, and the other tool that's available are Safe Harbor rules. So again, my question to the audience are: do you have a basic understanding of Advanced Pricing Agreement, or shall I explain this a little bit? If you can indicate, yes, I've got a response. We understand. Thank you, Kajal. Azad Kadri, sir. Okay, perfect. I can explain. Fine. And thanks, Kajal. You know about it. So probably you have read about it, or probably you're working in TP domain. That's fine. But for the larger audience, in very brief, and anyways, I think I should cover those aspects also. By the way, I've given legislative reference of APs as well as safe harbors here in the presentation, and I will share this presentation with Raj sir's team, and they can share it with our audience today. So advanced pricing agreement, as the name suggests, it is an agreement. It means it is a result of a long drawn negotiation process, and the negotiation happens between the taxpayer in India and the tax department or CBDT when they sign an agreement. So it is an official process whereby taxpayer files an application to the tax department or CBDT. They negotiate. It's a very long driven negotiation. Lots of resources, lots of time, energy, information is exchanged to agree on certain terms and conditions. And when this process ends, they end up signing an agreement, a written agreement between the taxpayer and the CBDT, which tells you what should be the pricing terms of your intercompany transactions, or what methodology you can adopt to determine the transfer price of your intercompany transactions. So that is advanced pricing agreement. It is applicable only for cross-border related party transactions. It means you cannot cover domestic related party transactions in an APA. You have to cover only cross-border related party transactions. That's given in the law. APAs can be a unilateral or a bilateral APA, and by theory, it can be a multilateral APA also, although practically we have not seen it. Unilateral APA is basically an APA between the taxpayer in India and the tax department. Two parties are involved, one jurisdiction. Bilateral is where two jurisdictions are involved, i.e., there are four parties involved in the negotiation process: the taxpayer in India, Indian competent authority, and taxpayers overseas related party is also involved in those negotiation process, and the competent authority of that jurisdiction, the tax authority of that jurisdiction is also involved. So four parties involved, two jurisdictions involved, and then competent authority of India gets an agreement with the overseas competent authority. And again, this is a negotiation process that happens between the two jurisdictions. For bilateral APA, you need to have Article 9(2) available in the DTAA, which is generally there in most of the Indian tax treaties. You will find Article 9(2). Safe harbor, on the other hand, if I explain safe harbor, these are basically these are very rigid rules which provide benefit to the taxpayer, which are framed to provide benefit to the taxpayer and reduce the controversy or litigation. And these are applicable for captive service providers if they are eligible SSCs. And of course, there are some eligibility criteria. You can find those eligibility criteria in the rules. I've given the legislative reference also. Safe harbor are unilateral measures available in the Income Tax Act. It means if you agree on a safe harbor rule, if you get your application approved, there might be a risk that the overseas company might have a double taxation on that particular cost, because overseas tax authority might not allow the other party that expense. So there is a risk of double taxation for the multinational group in safe harbor case. APAs generally take a lot of time. A unilateral APA might take anywhere between 1 to 2 years to be agreed. A bilateral APA takes even more time, probably 4 or 5 years, or even more than that to be agreed, because then you have a rigorous negotiation process, too much back and forth between the taxpayer and the tax authority, from Indian tax authority to the overseas tax authority, and so on and so forth. Safe harbors, on the other hand, are very simple. However, one important point which I forgot to mention is safe harbor rules basically lays down certain terms and conditions. So if you are an eligible SSC, and if you're meeting all those conditions given in the rule, only then you can apply and you can take benefit of safe harbor rules. Very rigid, no flexibility at all. However, the good point is you can get this safe harbor application approved very quickly. If you are meeting all the conditions and you apply to the tax department, it can be approved within 3 months also. The markup range that is agreed in the APAs versus what is available in the safe harbor. APAs are, as I mentioned, it's a negotiation driven process. So you tend to have a better outcome under an APA regime. So the markup which is generally agreed in an APA negotiation is somewhere in between 16 to 20%, depending upon the type of transaction you have, the functional characterization of the entity of the GCC you have. And again, these percentages for AP are based on the experience. These are not published anywhere. These are based on experience when we deal with similar, industry players. On the other hand, safe harbor, if you see the markup range which is provided in the safe harbor rules, of course, you cannot go up and down. These are the exact fixed percentages given in law, between 17 to 24%, depending upon the nature of transaction. So you have defined nature of transaction and you have to apply that particular markup only, 17 to 24%. You cannot deviate from that. APAs are the binding period for APAs. APAs are generally, as I said, it's a future agreement. So you can cover 5 future years, generally applicable for 5 future years, and you can also avail a rollback of 4 prior years. It means you can cover 9 years period under an APA application. Of course, there is a process you need to follow, application you need to make, you have to also pay a fees. There is an eligibility criteria also for APAs as well as for safe harbor. Safe harbors are only applicable or available for only for 1 year. Every year you have to make a fresh application. This is then the last slide for section 2. Do we have any questions? We understand. It sounds familiar. Advanced rulings. Yes. Asjad ji, advance ruling is different and advanced pricing agreement is different. Advanced ruling is generally available if you have any international tax related issues or taxation related issues. You can go for advanced ruling. Advanced ruling has a different wing, by the way, and APAs have a different wing. You will, when you apply for an APA, it's applicable only for international, for transfer pricing issues, APAs, and you deal with different set of officers under APA. I can pause here because next is our third section starting. I can pause here. We still have time. Any questions? Although I have tried to cover all the questions which have been posted so far. I hope whatever we have discussed until now is making sense, clear. If you have any questions, if you need any clarification, if you have any points to be added, if you have any inputs, if you don't agree with any of my thoughts, you can open your mic and you can say it now. Or we move to the next section then. Okay, perfect. Thank you. We move to the next section. What? Thank you, Neha. So the next is, we will cover other tax issues beyond transfer pricing, and a small disclaimer before I start. Is ICAI curriculum include GCC taxation issues in course? Ram ji, I don't think so. There is a course available for transfer pricing. I think last month, I mean, there is a course on international taxation. There is a course on transfer pricing, probably including that. There is no specific course on GCC, and GCC is basically an industry. The taxation concepts or the transfer pricing concepts which are applicable on other industries are similarly applicable on GCCs also. It is only how the particular, what do I say, taxation issues or transfer pricing issues have evolved in a particular industry. That's how, we try to specialize on those aspects. GCCs are set up as wholly owned subsidiary of foreign company or need any further recognition to be termed. No, it's okay. It could be, yeah, these are generally set up as a wholly owned subsidiary. However, it is a very popular concept, and you generally have, maybe you have seen, or at least I have seen, I can tell you that the GCCs, foreign companies, when they try to set up a GCC center in India, instead of starting off their own subsidiary, a wholly owned subsidiary, and setting up, making an investment, making a commitment, because this kind of setup also needs a lot of commitment in the form of funds, time, and so on and so forth. So before they commit anything to set up their own GCC centers, what they typically do is they hire a third party consultant, of course, including accountants. They hire a consultant, and the uh, consultant, they try to build a GCC for them, or a GCC setup. And when it is up and running, they transfer those setup to the headquarters, and then at that point of time they create their wholly owned GCC, a wholly owned company, and then it becomes a setup of the multinational group. However, both models are available and applicable as well. We have seen where GCCs or the multinational companies are coming over, setting up a company from scratch and setting up their GCCs from scratch. We have seen the other model also. What is your take on the recent Supreme Court judgment in Hyde? I was not trying to discuss, but if you can please hold on, Dinesh. On this slide, I will cover the PE aspect. I will not cover Hyde ruling as such, but I was about to cover the PE aspect on this slide. So if you can please hold on to that question. Thank you very much. I got your point. So, okay, fine. Let me begin with this, and let me begin with a disclaimer then, because I have seen the last point and I was actually about to give a disclaimer. Transfer pricing aspects we have discussed in detail. I have listed down 4 other tax issues apart from transfer pricing, of course. Those specifically on the PE, and there are some other tax issues which I have listed on the slide. Probably you will, or I felt that we might not do justice if we talk about these very important topics in 5 or 10 minutes. For example, PE issue itself would need probably 2 hours long discussion to understand what type of P's are there, what type of functions would form a P of a foreign company, and so on and so forth. And there are other tax aspects also, by the way. So what I'm going to do, I'm going to cover, or let's say I will touch upon these points now. Just to introduce these points, probably some of you might already are aware of these concepts, but I will just touch upon these points. And the idea is to make people aware of what kind of issues they may face if they are dealing with a GCC setup, if you are employed in a GCC, or if you are let's say working as a consultant, or if you own a GCC, what type of issues you might see. Not a full-fledged discussion, not a full deliberation, of course, but just for you to understand. Okay, let me see what other questions you have. I don't know what.
So, sir, while you reshare your screen, I had one question.
Yeah, please. Who is
So,
talking? Sorry.
I think the screen was not presented.
Kajol. No.
Yeah, Kajol.
Actually presenting the screen. Kajol,
Okay.
I'm presenting the screen. I have not presented any content yet. I
Oh,
was giving a
okay.
disclaimer.
Because we thought it is hung, so.
No. It is not. I'm giving a disclaimer before I present. Sorry.
Okay. So
Yeah.
one question I had, when we say that there are the GCCs or probably any MNCs would take help of consultants who can, probably formulate the entire model for them, and then they will incorporated in their business structure. In this case, who will actually be employed? Like, who will be the people who will be working in that case of setup? Will it be the consultant people? Will there be third party hiring? Will there be the MNC's employees itself? How will it work?
Yeah. So good question. Great question, I would say. In the other setup, we call it board setup. You build, operate, and then at one point of time you transfer that part to the MNC. In the board concept, hiring is of course done by the consultant. However, the GCC or the overseas company who is about to start the business or the GCC setup, they are the ones who are actually involved in hiring people, what type of people they need, what type of experience they need, and so on and so forth. So they are actually involved in setting up of the center here. If you probably need, some kind of specialized hardware, software, whatever it is, so they are involved, but the cost is the cost of the consultant. And then of course there is an arrangement between a consultant and the overseas company, and that is basically a commercial agreement they will have. And within that commercial agreement, generally they subsume at one point of time when they are making an initial investment, it will be transferred to the overseas company at some point of time as on a going concern basis. So even that consideration is also included either in the price which they are agreeing, or probably in their agreement they will have to give consideration to those aspects also.
Okay,
Perfect, thank you very much. Okay, where is my not hanged? Okay, so first and foremost, PE risk. I don't know if my screen is properly visible to everyone.
yes, it is.
Okay, it will come, don't worry. PE risk, I hope this concept is known to everyone. When a foreign company might have a taxable presence, or if they have a significant economic presence in India, then it is alleged that, or generally tax authority alleged that there is a PE of foreign company in India. And PE can be in the form of a service fee, specifically in a GCC setup. Now these are all not that there are cases, but there could be real cases as well, just for you to aware of all these concepts. Service fee, where of course there is a continuous movement of people from overseas to India, and if they are performing certain services while they are in India, then there could be a service fee which is probably for a shorter duration. Fixed place PE, if the overseas company is using the fixed place of business of the GCC, if it is at their disposal and they are performing substantive activities from that fixed place of business, then it could be alleged by the tax authorities that foreign entity might have a fixed place PE in India. Dependent agent PE is basically in all those marketing setups where you have a marketing support team sitting in India, they are making calls trying to sell something. And if casually they negotiate significant terms of the contract or enter into a contract with the customer, which might be binding on the overseas company, then it may create a dependent agent PE of a foreign company in India. So very, very briefly, PE issue. And I saw Dinesh, you posted a question, what about Hyatt ruling? Hyatt ruling, by the way, is not a GCC setup. So that's a distinguished ruling, but you do have some rulings with respect to GCC as well. But the bottom line is the GCC setup can also pose a PE risk, where we as a consultant or as a tax expert, we need to the consideration should be on the aspects of when you are reviewing intercompany agreement of the GCCs, or when you're actually doing a transfer pricing analysis. So within that you do a functional analysis also, how many people are coming, how many days they have spent, what kind of activities they are doing. If people from overseas are coming over to India, are they working under the direction, supervision, and control of the overseas company or the foreign company? If yes, then there is a highly likely chances that a P can be formed. Not necessarily it will be found, but there is a high chance that it might create a P. So you need to be very, very careful when you're reviewing those agreements or drafting those agreements when you are actually conducting the business. So in generally, when these kind of setups are being done, we typically issue some do's and don'ts to the taxpayer and its overseas company, that you can do these activities. Okay, if you are doing some other activities, then you might have a problem. You might have a PE risk. And what is the risk here? If, let's say, if tax authorities have alleged a PE of the foreign company in India, then the PE or the foreign company in India will have to get itself registered under the regulatory, with the regulatory and taxation bodies. You might have to do your accounts. You have to get your accounts audited. You'll have to pay your taxes, file your returns. Like, it's a complete nightmare. And then, of course, 40% taxation plus surcharge and cess. So you need to be aware of it. Dineshji, if you still have any questions on Hayat ruling, may I suggest we can talk offline, because I was not trying to cover Hayat ruling in this session. But by the way, very good point. If this is all over the social media, by the way, if you want to read the case law, very interesting case law, Hayat ruling, and there are some references to other case law also, and within that there is a case law specifically on a GCC as well, GCC setup. Is it a message? Never mind. I shall get connected. Yes, sir. Definitely. Please do that, Batraji. Next is, why is it? Okay, fine. Secondment from headquarters. So we saw people continuously coming over, whether to impart training or to set up the GCC center, initial services, and so on and so forth. Apart from the PE risk, which we saw above, you also have to consider what are the individual taxation aspects you need to see. Basically, what is the duration of that secondee employee in the host jurisdiction? What type of visa that person might need? Social security benefits that person might be eligible for while in India, individual taxation. If you are paying, if that person is getting some compensation in the home jurisdiction as well as in the host jurisdiction, so where will that person report his or her global income in India or overseas? If that person is paying taxes in both the jurisdictions, so how do you get credit in which jurisdiction? How the double taxation avoidance agreement principles are applied? So all these aspects are extremely important in a GCC setup, specifically for secondment of people from overseas to India. And one more point, which I mentioned in the previous point, if that secondee employee is coming over, whether that person is working under the direction, supervision, and control of overseas company, high PE risk, versus the Indian GCC management, which is lower risk. And it is more recommended that once a person is being seconded, that person should work under the direction, supervision, and control of Indian company, not the foreign company. So when you're reviewing agreements or drafting agreements or giving an advice, these are some minute details you need to consider.
So this can also lead to service P risk
Yes, yes, yes.
or fixed
There is
place.
a minute difference between service PE and a fixed place PE, I would say.
Hmm.
But you're right. It can lead to a service PE as well as a fixed place PE as well, both.
Okay.
Yeah. Withholding tax, as we all know, and I'm sure all the practicing CAs in this room are engaged in doing 15 CACB. So when you do that, you need to see what is the nature of transaction, what is the domestic rate versus the rate available in the tax treaty, which is generally a beneficial rate. So how can you avail the beneficial rate? What are the documentations required, and whether you have those documentations, and so on and so forth. So again, these are some important points. 15 CACB, why is it relevant? Because in that, you as an accountant or us as an accountant are actually signing off on the form of transaction and what is the withholding tax you need to pay or the taxpayer needs to pay. So that is important for us as an accountant to make sure these are the aspects you need to check. Last but not the least, and this comes with a small caveat, I am not an indirect tax expert. So if there is anyone sitting in the audience who might be an indirect tax expert, I think we are over time. So I will very quickly run through this. If you have any inputs, any points, please feel free to chip in. And before I move further, Divya or Keshav, we are, I think, over time. Can we continue for like 5-10 minutes?
Yes, sir, we can continue for 5-10 minutes.
Okay, perfect. So I will very quickly wrap up on the indirect tax aspects. Um, so there are a couple of interesting points. One is the secondment charges. In secondment charges, we have seen these are generally considered as cost to cost reimbursements, as at least until 2 years ago. And then there was a controversy going around, and in 2023, Supreme Court in Northern Operating Systems case came up with this interesting ruling where they considered reimbursement or the secondment agreement as manpower supply agreement, and hence subject to 18% GST under the reverse charge mechanism. And immediately after that ruling, there was an internal circular issued by the board to apply the ruling across the board. So this probably has become an industry-wide issue, and there are some steps being taken by the industry bodies. Second is, and this is a latest twist which we have seen in some audit cases, GST audit cases, the core services supplied by GCC were generally considered as export of services with zero rated supply, and you are also able to claim the input tax credit on those. Now the department officers have come up with an interpretation. They are saying these are intermediary services and subject to 18% GST. So all indirect tax practitioners in this room, probably you have a little bit more work to do on these aspects. I'll just quickly move on and wrap up because this is the last couple of slides. What are the key opportunities, challenges, and mitigation? If I talk about opportunities, of course, as I mentioned in the beginning, market is really, big market. There is a huge potential. India is all set to grow at a rate of 10% YOY. In next 5 to 6 years, Indian GCC industry will become more than $100 billion industry. So lots of opportunities for all kind of professionals, not only for accountants. There are some emerging roles in engineering, AI, ESG professionals, global tax leads, and so on and so forth. The new growth trend is likely to be seen in tier 2 and tier 3 cities. If we talk about challenges, the cost inflation management, even in India, if you see all the big cities, Bangalore, Delhi NCR, Mumbai, etc., no more they are there is no more cost arbitrage, so to say. However, if you go to tier 2 and tier 3 cities, you will find rentals are competitive, and even the paychecks are not that heavy. Skill gap, of course, there is a problem finding right talent for the right kind of activities, and that goes hand in hand with the initial thought, the two pillars which I mentioned, three pillars which I mentioned. Institutions, all the institutions like ICI, IITs, IIMs, they also have to include in their curriculum all the latest trends, technologies, developments across the globe. And also individuals, professionals like us, or engineers, medical professionals, lawyers, etc., they also have to level up and upskill their abilities to perform high quality services. Cultural integration, of course, it can be dealt with cross-border rotations. If in a GCC setup, it's a very common phenomena. You see people coming over from overseas in India, and Indian people are also going abroad to, have trainings, to have interaction beyond work as well. So these are some opportunities, challenges, mitigation. In summary, Indian GCC landscape is changing very fast. Lots of opportunities. Tax and transfer pricing regime is getting more and more complex. So lots of opportunities for accountants and tax professionals. There is a need for government also to come up with policy reforms, and of course institutions and professionals also have to step up their game to make sure we are all competitive in the global market. So that is the end of my presentation. We are slightly above our time, so probably if you have any questions, although I try to answer all your questions within the time frame. Any questions, any more
Yeah,
questions you have?
I have one question before we sign off, and this is not probably it would not be related to the presentation, but because these days GCC is considered as a trend, I just wanted to understand from job market perspective, like for tax professionals, how much is GCC coming up, and should it be considered considering the changing future?
So, sorry, Kajal, I did not actually follow your question. So you're trying to understand what is the pay.
Basically, for tax professionals, if they would be thinking to move to GCC setup, or to get employed in that setup, how the future looks like in that manner.
Yes, so I would say future is really, really bright in the GCC setup. Whether you are working as an employee in a GCC, or you are as a consultant, you're working in a GCC, or if you're owning a GCC.
Hmm.
There is no doubt about it. If the industry in India is expected to grow at a 10% growth rate YOY in the next 5-6 years. And we have seen, did I mention about that gift city which is being established
Yes,
by the
Ahmedabad, but not more on that. Hmm.
well, not more on that, but my take on the policy reforms is we definitely need these kind of setup on a pan India basis, and I'm sure there you will see over the next 4-5 years, Gift City Ahmedabad will be replicated in other parts of the world as well, and this is happening not because they want to develop only Gujarat as a hub, but the intent of the government is they actually want India to become a global delivery hub, which India is, in India is a world leader, as I mentioned. And this industry will grow, and accordingly, people working in this industry will also grow. And now the question is how much an individual can grow in this domain or in any other domain for that matter. It depends on that individual because the trend is changing very fast. If you see, if I take an example of a computer software engineer, what you may have learned in the last, let's say, 5 years ago may not be that relevant now because technology is changing very fast. Even in the taxation, so new concepts are coming in taxation, international taxation, new things are coming up. So you have to, you know upskill yourself. I'm not taking you as an example, by the way. I'm saying generally, if you are a professional and if professional wants to make sure that you're relevant, you have to actually continuously learn and upskill yourself to be relevant in your domain. That's it. And then growth is, you have tremendous growth in this industry for sure.
Understood.
Thank you. Any other question? All right, thank you very much. If you have any further questions, you have my coordinates. If you need any other topics in future, please do drop me a note. WhatsApp will be the best option for reaching out to me. You can, this is my number, my email, and you can drop me a WhatsApp, give me a call as well. Yeah, I would really like to stay in touch with everyone. Thank you very much. Wonderful. Thank you very much. And should I hand it over to Keshav, Divya, or who else
Thank
is
you,
there?
sir, for having us such a wonderful session. I think it's a time to end the session.
Yeah, thank you very much. Thank you. Thank you.
Thanks, Parag.
Neha.
Thank you for the insightful session.
Thank you, Akhil. Thanks for joining.
Thank you. Bye.
Thanks.